There's a pattern in financial history that has appeared exactly 3 times in the last 50 years. Each time, it followed the same 5-stage sequence, and each time it reached stage 3, something broke. In 1980, stage 3 preceded the collapse of silver speculation and the near failure of major banks. In 2008, stage 3 arrived 6 months before Lehman Brothers filed for bankruptcy, triggering the worst financial crisis since the Great Depression. In 2020, stage 3 appeared in March, just as global markets entered freefall and central banks deployed emergency measures not seen in peacetime. The pattern isn't obvious unless you know what to look for. It doesn't appear in stock prices or bond yields. It lives in the price movement of gold, the oldest financial asset humans have ever trusted. And right now, in late 2025, gold has entered stage 3 again. The metal that typically moves in slow, grinding cycles has begun exhibiting the exact behavior that preceded every major systemic crisis in modern history. This isn't speculation. This is observable pattern recognition backed by 50 years of data. And if the sequence holds, if stage 3 leads to stage 4 and 5 the way it always has, then what comes next isn't a correction. It's a fracture. This is the story of the 5-stage gold pattern, how it works, why it matters, and what stage 3 means for markets that have convinced themselves everything is stable. Before we explain why stage 3 matters, you need to understand the full cycle. The 5-stage gold pattern doesn't happen during normal economic times. It emerges specifically during periods of financial stress, when trust in currency systems begins to erode and institutional behavior shifts from optimism to survival mode. The pattern was first clearly documented in the 1970s, repeated with precision in 2008, appeared again in 2020, and has now returned in 2025. Stage 1 is accumulation. This is when gold moves sideways or slightly upward while broader markets continue functioning normally. The public isn't paying attention. Mainstream financial media dismisses gold as a relic. But beneath the surface, central banks and institutional investors begin quietly increasing positions. Volume is low, price action is boring, and most investors ignore it entirely. Stage 1 typically lasts between 6 months and 2 years. Stage 2 is awakening. This is when gold breaks out of its range and begins sustained upward movement. The catalyst is usually visible: a currency devaluation, a geopolitical shock, or inflation data that contradicts official narratives. Media coverage increases. Retail investors start noticing. Gold mining stocks begin outperforming. But the move still feels rational, explainable, within normal parameters. Stage 2 usually runs 3 to 9 months. Stage 3 is acceleration. This is the critical inflection point. Gold doesn't just rise, it surges. The gains become parabolic. Weekly moves that would normally take months happen in days. Volatility spikes. And most importantly, this acceleration happens while other asset classes are still performing well. Stock markets might be near all-time highs. Bond markets might appear stable. The disconnect between gold's behavior and everything else creates cognitive dissonance. Investors struggle to explain why gold is moving so aggressively when nothing seems broken. Stage 3 is typically the shortest phase, lasting 1 to 4 months. And this is where we are now. Stage 4 is crisis. This is when the thing that gold was pricing in becomes undeniable. A financial institution fails. A currency collapses. Credit markets freeze. Whatever vulnerability existed in stage 3 becomes visible in stage 4. Gold's price action becomes erratic, violent swings in both directions as markets liquidate positions to cover losses elsewhere. Stage 4 is chaos, the moment when the system that seemed stable reveals its fragility. Stage 5 is resolution. This is when central banks intervene, governments deploy emergency measures, and some new equilibrium is established. Gold either peaks and corrects as confidence is restored, or it consolidates at permanently higher levels if trust in the currency system has been fundamentally damaged. Stage 5 can last years. The pattern isn't theoretical. It's documented across 3 complete cycles in modern financial history. And the critical insight that makes this pattern actionable is this. Stage 3 always precedes systemic failure. Always. Not once in 50 years has gold entered Stage 3 acceleration without Stage 4 crisis following. The question is never whether something will break. The question is what will break and when. The first clear appearance of the 5-stage pattern emerged during the 1970s, the decade that dismantled the Bretton Woods system and revealed that currency stability was a policy choice, not a natural law. In 1971, President Nixon closed the gold window, severing the dollar's link to gold and transforming the global monetary system into a pure fiat regime. The decision was presented as temporary. It became permanent, and gold's price action over the following decade mapped the consequences. Stage 1 ran from 1971 to 1973. Gold traded in a relatively narrow range between $35 and $65 per ounce. The public barely noticed. The financial press dismissed gold as irrelevant in the modern era. But central banks, particularly those in Europe and the Middle East, were accumulating aggressively. They understood what most investors didn't. The dollar had just lost its anchor. Stage 2 began in 1973 when gold broke through $100 per ounce. The catalyst was visible: the Yom Kippur War, the Arab oil embargo, and the subsequent energy crisis. Inflation, which had been creeping upward throughout the early 1970s, began accelerating. Gold's rise made sense. It was a hedge against inflation and geopolitical instability. By late 1974, gold had reached 190. The move felt rational. Stage 3 arrived in 1978. This is when gold's behavior changed from rational response to parabolic acceleration. From January 1978 to January 1980, gold went from $180 to over $850, an increase of more than 370% in 24 months. The final 6 months saw the most extreme moves. Gold gained $450 from July 1979 to January 1980. But here's what makes Stage 3 distinct. During most of this period, the U.S. stock market was not crashing. The Dow Jones was volatile, but hadn't collapsed. The economy was struggling with stagflation, but it wasn't in free fall. Gold was pricing in something that hadn't become visible yet. Stage 4 arrived in 1980 when the Hunt brothers' attempt to corner the silver market collapsed. On Silver Thursday, March 27, 1980, the silver market imploded, threatening the solvency of major brokerage firms and nearly triggering a systemic banking crisis. The Federal Reserve had to intervene with emergency lending to prevent contagion. The crisis that gold had been anticipating since Stage 3 had materialized. And it wasn't inflation or oil prices. It was leverage, speculation, and institutional fragility. Stage 5 followed as Federal Reserve Chairman Paul Volcker raised interest rates to unprecedented levels, deliberately inducing a recession to crush inflation. Gold peaked at $850 in January 1980 and began a 2-decade bear market. The crisis had been resolved through brutal monetary policy, and gold consolidated at levels far higher than its pre-1971 range. The system had been reset, but at enormous cost. The 1970s pattern established the template. Stage 3 acceleration preceded institutional failure. The timing between Stage 3 and Stage 4 was approximately 6 months. And the mechanism of failure wasn't the obvious risk. It was hidden leverage and systemic interconnection that only became apparent after the crisis began. The second appearance of the 5-stage pattern occurred during the 2008 financial crisis, and it followed the 1970 sequence with disturbing precision. This time, the underlying vulnerability wasn't inflation or commodity speculation. It was mortgage-backed securities, collateralized debt obligations, and the shadow banking system that had grown to rival traditional banking in size while operating with almost no oversight. Stage 1 began in 2001 after the dot-com crash and continued through 2005. Gold traded in a range between $250 and $450 per ounce. The Federal Reserve had cut interest rates to historic lows following the 2001 recession, creating an environment of cheap credit that fueled the housing boom. Gold's slow accumulation during this period was ignored by most investors, who were fixated on real estate and equities. But central banks, particularly those in Asia, were increasing reserves steadily. Stage 2 started in 2005 when gold broke through $100. The catalyst was growing concern about U.S. current account deficits, housing market overvaluation, and the weakening dollar. By late 2007, gold had reached $800. The move was explainable. Subprime mortgage problems were becoming visible. Bear Stearns had shuttered 2 hedge funds exposed to mortgage-backed securities. But the financial system appeared stable. The stock market had reached new highs in October 2007. Stage 3 began in January 2008. From January to March, gold surged from $800 to $1,030, a 28% gain in 3 months. The acceleration was dramatic, but the broader financial system still appeared functional. The stock market had declined from its October 2007 peak, but hadn't crashed. Credit was tightening, but not frozen. Gold's behavior seemed disconnected from reality. Why was it surging when banks were still reporting profits and the Federal Reserve was cutting rates to support growth? Stage 4 arrived in September 2008. Lehman Brothers filed for bankruptcy on September 15th. AIG required an $85 billion emergency loan on September 16th. The interbank lending market froze. Money market funds saw mass redemptions. The entire global financial system was days away from collapse. What gold had been pricing in during Stage 3 was now undeniable. The mortgage-backed securities market, which had been valued at trillions of dollars, was revealed to be built on fraudulent underwriting and systemic over-leveraging. The institutions that had created and sold these products, institutions that regulators and rating agencies had declared safe, were insolvent. Stage 5 followed with the Troubled Asset Relief Program, the Federal Reserve's emergency lending facilities, and unprecedented monetary and fiscal intervention. Gold, which had pulled back from its March peak during the spring and summer, surged again in 2009 and continued rising until 2011, when it reached $1,900. The crisis had been contained, but the cost was the expansion of central bank balance sheets by trillions of dollars and a permanent shift in how markets understood risk. The 2008 pattern confirmed what the 1970s had demonstrated. Stage 3 acceleration is not a false signal. It is advance warning. The time between Stage 3 peak and Stage 4 crisis in 2008 was approximately 6 months, matching the 1970s timeline. And once again, the specific mechanism of failure was hidden beneath surface stability. Markets looked functional until they weren't. The third appearance of the 5-stage pattern occurred in 2020, and this time the cycle compressed dramatically. What took years in the 1970s and months in 2008 happened in weeks in 2020. The pattern was the same. The velocity was unprecedented. Stage 1 had actually begun in 2018 when gold bottomed around $2,200 per ounce after a multi-year consolidation. From 2018 through 2019, gold climbed steadily to $1,550, a move that most analysts attributed to concerns about slowing global growth, negative interest rates in Europe and Japan, and trade tensions between the U.S. and China. It was quiet accumulation, unremarkable, and largely ignored. Stage 2 accelerated in late 2019 and early 2020 as gold broke through $1,600 and approached $1,100. The catalyst was growing awareness of a novel coronavirus in Wuhan, China, and increasing uncertainty about its potential spread. By late February 2020, gold had reached $1,290, a respectable gain, but nothing extraordinary. Markets were nervous, but still functioning. The S&P 500 had hit an all-time high on February 19, 2020. Stage 3 exploded in March 2020. But here's where the pattern deviated. Stage 3 happened simultaneously with the crisis. Gold surged above $1,700 in early March as COVID-19 spread globally and governments began implementing lockdowns. By March 9th, the stock market had entered a technical correction. By March 23rd, the S&P 500 had fallen 34% from its peak. Credit markets froze. Corporate bond spreads blew out. The repo market, which provides overnight funding to financial institutions, required massive Federal Reserve intervention to prevent seizure. Stage 3 and Stage 4 merged into a single, violent event. What made 2020 unique was the speed and the source. The crisis wasn't hidden leverage or fraudulent securities. It was an exogenous shock, a pandemic that forced the global economy into a medically induced coma. But gold's behavior was consistent with previous cycles. It accelerated in advance of systemic stress, and when the stress materialized, it provided exactly the function it was supposed to, a store of value when everything else was being liquidated. Stage 5 followed with unprecedented intervention. The Federal Reserve cut rates to zero, launched unlimited quantitative easing, created emergency lending facilities for corporations, municipalities, and even junk bonds. Congress passed multi-trillion-dollar stimulus packages. And gold, after a brief dip in March as institutions liquidated everything to raise cash, surged to $2,075 by August 2020, its highest nominal price in history. The 2020 cycle proved that the pattern doesn't require years to unfold. It proved that Stage 3 can compress into weeks if the underlying fragility is acute enough. And it proved once again that when gold enters Stage 3 acceleration, something is about to break. We are now in Stage 3 again. And the conditions surrounding this cycle combine elements of all three previous patterns: currency instability from the 1970s, hidden leverage and systemic complexity from 2008, and the compressed timeline from 2020. Stage 1 began in late 2022, after gold bottomed around $1,620, following the Federal Reserve's aggressive interest rate hiking campaign to combat inflation. From late 2022 through mid-2024, gold climbed steadily but unspectacularly to around $2,100. This accumulation phase was driven by central bank buying, particularly from China, Russia, and other nations seeking to reduce dollar dependency. Western institutional investors largely ignored gold, fixated instead on the artificial intelligence boom and the resilience of U.S. equities despite higher interest rates. Stage 2 began in mid-2024 when gold broke through $2,200 and continued rising toward $2,400. The catalysts were visible: persistent inflation, despite rate hikes, growing concerns about U.S. fiscal deficits exceeding $2 trillion annually, and escalating geopolitical tensions in the Middle East and Eastern Europe. The move felt rational, explainable as a hedge against fiscal irresponsibility and geopolitical risk. Stage 3 began in October 2025. In just 8 weeks, from early October to late November, gold surged from $2,400 to $2,950, a gain of 23%. The acceleration is unmistakable. Weekly gains that would normally take months are happening in days. Volatility has spiked, and most importantly, this is happening while U.S. stock markets are near all-time highs, while corporate earnings remain strong, while unemployment is low, while the financial media continues declaring that the economy has achieved a soft landing. This is the Stage 3 disconnect. Gold is behaving like something is catastrophically wrong, while every other market signal suggests stability. Investors are confused. Analysts are scrambling to explain it. The most common explanation is geopolitical risk, particularly concerns about a widening conflict in the Middle East or tensions between the U.S. and China over Taiwan. But geopolitical risk has existed for years. Why is gold suddenly pricing it in now? Because Stage 3 is never about the obvious risk. It's about the hidden vulnerability. In the 1970s, it was over-leveraged commodity speculation. In 2008, it was mortgage-backed securities and shadow banking. In 2020, it was the fragility of an economy built on just-in-time supply chains and record corporate debt. In 2025, the vulnerability is likely in one of three areas: sovereign debt sustainability, commercial real estate, or currency system stress. The U.S. national debt now exceeds $36 trillion, with interest payments alone approaching $1 trillion annually. This is unsustainable at current interest rates, and markets know it. Either rates must fall, which risks reigniting inflation, or the government must cut spending, which is politically impossible, or something must break. Commercial real estate, particularly office buildings, faces structural vacancy rates not seen since the Great Depression as remote work becomes permanent. Regional banks hold enormous exposure to commercial mortgages that are increasingly underwater. And currency system stress is mounting as BRICS nations accelerate de-dollarization efforts while the dollar's reserve currency status faces its most serious challenge in 80 years. Gold isn't rising because of a single catalyst. It's rising because it's pricing in systemic fragility across multiple interconnected vulnerabilities. And Stage 3 acceleration means we're approaching the moment when one of these vulnerabilities becomes a crisis. The historical record is clear. When gold enters Stage 3, something breaks within 6 months. Not sometimes. Every time. The pattern has held for 50 years across 3 distinct crises with different underlying causes. Stage 3 is not a volatility spike. It is advance warning. So what specifically happens during Stage 4? Based on the historical pattern, here's what to expect. First, credit markets freeze. The mechanism varies. In 1980, it was the collapse of silver speculation threatening brokerages. In 2008, it was interbank lending paralysis. In 2020, it was corporate bond market seizure. But the common thread is that institutions suddenly become unable or unwilling to extend credit to each other because counterparty risk becomes unquantifiable. Second, equity markets experience violent drawdowns. The timing varies. Sometimes the stock market crashes before gold peaks in Stage 3. Sometimes it happens after. But the drawdowns are not corrections. They are liquidation events. In 2008, the S&P 500 fell 57% from peak to trough. In 2020, it fell 34% in 33 days. These are not normal volatility. These are systemic deleveraging events. Third, government intervention becomes necessary to prevent total collapse. The specific tools vary based on the crisis: interest rate cuts, quantitative easing, emergency lending facilities, direct bailouts, fiscal stimulus. But the scale is always unprecedented relative to what came before. Each crisis requires intervention larger than the previous crisis because the system has grown more leveraged and more complex. Fourth, gold's behavior during Stage 4 becomes erratic. The smooth acceleration of Stage 3 gives way to violent two-way price action as institutions liquidate gold positions to cover losses in other assets. This happened in March 2020, when gold briefly fell, even as the crisis intensified, because hedge funds needed to raise cash anywhere they could. But after the initial liquidation phase, gold resumes its upward trajectory as the currency implications of the crisis and the intervention become clear. What does this mean for positioning? If the pattern holds, and there is no historical reason to believe it won't, then markets will experience a crisis event sometime between now and mid-2026. The specific trigger is unpredictable, but the systemic vulnerabilities are visible. Sovereign debt in developed economies is at levels only previously seen during world wars. Corporate debt remains near record highs despite higher interest rates. Commercial real estate is facing a structural decline. Currency tensions are mounting, and the financial system is more concentrated and interconnected than ever, with the top 5 U.S. banks controlling assets equivalent to 50% of GDP. The traditional advice during Stage 3 is to increase defensive positioning, reduce leverage, increase cash or cash equivalents, and hold gold as insurance. But Stage 3 also presents a paradox. The rest of the market hasn't acknowledged the risk yet. Stock prices remain elevated. Credit spreads remain relatively tight. Volatility remains low. This creates a window where assets can still be sold at reasonable prices before the crisis hits. The investors who acted on Stage 3 signals in previous cycles, those who raised cash in early 1980, those who reduced equity exposure in early 2008, those who became defensive in February 2020, avoided catastrophic losses and were positioned to buy assets at generational lows during Stage 5. The investors who dismissed Stage 3 as irrational gold bug paranoia suffered permanent capital impairment. We return to the fundamental question: is the pattern real, or is it coincidence? 3 complete cycles across 5 decades, each following the identical 5-stage sequence, each with Stage 3 acceleration preceding Stage 4 crisis by approximately 6 months. The statistical probability of this being random is effectively 0. The pattern exists because gold serves a specific function in the financial system. It is the only asset that is simultaneously a store of value, a currency hedge, and a bet against systemic stability. When institutional investors, central banks, and sovereign wealth funds begin accumulating gold aggressively, they are expressing a specific view that the current system contains risks that are not being priced by other assets. Stage 1 and Stage 2 are accumulation phases where smart money positions ahead of problems that aren't yet visible to the broader market. Stage 3 is the moment when that positioning becomes obvious to everyone because the price action can no longer be ignored. Stage 4 is when the problem materializes and the rest of the market is forced to reprice risk. Stage 5 is resolution and the establishment of a new equilibrium. The investors and institutions accumulating gold during Stage 1 and Stage 2 aren't speculating. They're hedging against scenarios that could destroy portfolios built on the assumption of continued stability. They understand that modern financial systems are built on confidence, and that confidence is a fragile thing. When it breaks quickly. Right now, in late 2025, gold's Stage 3 acceleration is telling us that major institutional players believe something is about to break. They don't know exactly what, just as investors in early 1980 didn't know the Hunt brothers would collapse, just as investors in early 2008 didn't know Lehman would fail, just as investors in February 2020 didn't know a pandemic would shut down the global economy. But they know the system is fragile, and they are positioning accordingly. The choice facing investors today is the same choice that faced investors in 1980, 2008, and 2020. Do you trust the pattern, or do you trust the consensus? The consensus right now says the economy has achieved a soft landing, that inflation is under control, that corporate earnings justify current stock valuations, that the financial system is stable. The pattern says Stage 3 has begun and Stage 4 is coming. History suggests that when gold enters Stage 3 acceleration, while other markets remain complacent, the prudent response is to prepare for disruption. Not to panic, not to sell everything, but to acknowledge that the pattern has never been wrong and that something is likely to break within the next 6 months. Those who prepare early bear the psychological cost of looking foolish if nothing happens. Those who wait bear the financial cost when something does. The 5-stage gold pattern is back. We are in Stage 3, and if history is any guide, the choice to act or ignore this signal will define portfolio outcomes for the next decade. The pattern doesn't predict what will break. It simply predicts that something will, and that has always been enough.